Many of you might think that Canada has a debt problem, especially after COVID-19 and the government giving out a bunch of subsidies like CERB or CESB. Where are they getting all this money from, and who's going to pay for it? In this video, we're going to talk about everything you need to know about how the government actually prints money and what you should do with your money instead and how this might affect your purchasing power going forwards. If you guys are new here, my name is Daniel, and here on this channel we talk about stock market investing. In this Monday series, I'm going over my TFSA portfolio at the end of this video and talking about what buys and sells I did last week and what I'm going to be doing in the week going forwards. If you're interested in that, consider subscribing down below. I talk about different topics every week and try to make it interesting and not just about stocks. This will give you a broader understanding of the market and how different things can impact the stock market in their own way. And by the way, I do have a free course down below. If you haven't signed up for Skillshare, you get a 14-day trial. You can watch the entire course and build a portfolio tracking spreadsheet from scratch. That way, you know how to fix the spreadsheet if it breaks one day, and you can add more features on top of that. It'll teach you some basics of Google Sheets along the way in a fun and educational manner. So getting right into it. First off, let's go over the history of how money came to be and what it was actually backed by in the beginning. If we go back as far as the 1800s, I'm not going to go back further than that, but ultimately money was actually backed by gold, or it was called the gold standard. So this is how countries did trade amongst each other. Otherwise, countries could continuously print money without another country knowing and screw them over when they're doing trade internationally. So countries adopted the gold standard in order to have a fair way to exchange value across countries that don't use the same currency. Ultimately, the gold standard was scrapped early on in the 1900s and it was replaced by the Bretton Woods system, at least for about 44 countries or so. And what happened here was that the US dollar was the main currency that all other currencies were tied to, and the US dollar was pegged by gold. However, in the 1970s, that decided to dissolve as the US government needed to print money in order to stimulate the economy. So after getting rid of the gold standard, they got rid of the Bretton Woods standard, and now no currency is actually tied to gold. But ultimately, currencies are now valued by supply and demand. So countries that produce a lot more value, or GDP, their currency will be valued at a higher amount because people want to do business with those companies that are in that country and need the currency local there to do some trade. And we can see the US dollar is still like the currency of the world just because of how dominant the US economy is. But over time, that could change. So now that we know currencies aren't actually backed by anything, then how do governments or countries actually print money? And this is the biggest question that most people had this year. A lot of people think they just take out the printing press and make real currency. But rather, that's a small fraction of the amount of currency they print. The main way that central banks get their money is through creating it digitally by entering it into their bank account and just crediting themselves like $1 million or $1 billion. Or they can create bank reserves issued to commercial banks. Now, the central bank can't just go out there, print money irresponsibly. They actually have a mission, and their mission is to either stabilize the economy or keep inflation to a certain target. And also, they work in tandem with the government. So remember, the central bank is not actually part of the government, but they work with the government in order to help stabilize the economy. So if central banks print the money, how does the government get it since they're not tied? Well, what the central banks do is when they make their money, they buy government bonds. And that's how the government gets their money. By issuing bonds, they promise the people who they borrow from a certain interest rate and a repayment by a later date. And oftentimes, they're borrowing from the central bank. So in a way, you could say the central bank, yes, they can make money, but the government of Canada will eventually pay it back. Now, the central bank doesn't really hold any money because they can create an infinite amount. Rather, you could say when the money is returned to the central bank, it's effectively destroyed. So in a way, you could say they're not actually creating any new money because eventually it's going to go back to them and it's going to be destroyed. But rather what they're doing instead is backing the government and providing liquidity to the government when they need it in order to stimulate the economy. So right now, I guess we are living in a period where the government is getting a lot of money and giving it out to citizens and using it to boost the economy. But eventually we're going to have to pay that all back to the central bank once these bonds mature. And with the whole pandemic happening last year and the government needing to spend upwards of $300 billion, the government had to issue bonds, and the Central Bank of Canada was a major buyer of these bonds. If we look at the deficit of the government of Canada, it rose from around $700 billion all the way to $1 trillion in a year. So we increased our deficit by $300 billion. Now, compared to the States, that's nothing. But for Canada, that's a lot. And remember that our population is about 1/10 of the US right now. If we go back to 2015, the Canadian government deficit was only around $600 billion. So in the span from 2015 to 2019, it increased by only $100 billion. But from 2019 to 2020, it increased by $300 billion. So an increase in the government deficit of $300 billion may not sound like a lot compared to the States, but if you look at the overall debt and how much we accumulated in a single year, that is a massive amount. So this has really got Canadians worried about how we're going to pay this back. Remember, this is only the federal debt we're talking about. I think in all of Canada, the total debt across the provinces' governments, as well as the federal governments, we're looking more like $2 trillion. So this might be what you're thinking in the back of your mind. How are we going to dig ourselves out of this debt problem? And I would say there are two answers to this. Well, the first one is we either pay it back and increase taxes, which nobody likes, or what the government of Canada is banking on, and most people are banking on, is that the economy grows large enough that this debt starts to look smaller and smaller as we go forward in the future. Because remember, the government borrowed to use the money today, but they're paying the money back at a later date. And right now we see inflation increasing like 5% in a single month. This means that when creditors are giving back their dollars tomorrow, or basically 5 or 10 years down the road, that dollar would have eroded in purchasing power. So the $300 billion that the government is borrowing today, when they're paying back the $300 billion down the road 5 to 10 years from now, its purchasing power could look more like $100 billion down the road. So this is probably one reason why the government isn't too worried about taking on more debt right now. So wrapping up this segment, how does this actually affect you and your purchasing power? Well, the one thing I'm going to say here is that right now is a bad time to leave money in your bank account because we can see inflation is rising rapidly. The CPI index recently reported an increase of around 4 to 5% in the past 2 months. And typically, just for your information, governments target a 2% inflation. But in a single month, we're seeing 4 to 5%. That's crazy. And if you guys have been in the market or you guys have been looking at prices of lumber, for example, you'll see the inflation for these products have skyrocketed way more than 4 to 5%. We saw the stock market and tech stocks and growth stocks grow like crazy last year, some companies even like 10x. And we saw lumber prices themselves increase by 4 to 5x. So rather, if you have money sitting in a bank account, you probably want to start looking at investing this money somewhere. At least earning interest in a high interest savings account, that's better than sitting in a checking account. But if you want to go one step further, consider looking at real estate or stock market investing. However, just beware that these assets are also fairly inflated in their prices. And that's because interest rates are low. Now on the buying front, you're going to notice that a lot of prices are going to be increasing in the next year. At least this is what I believe. I believe that things like groceries, which haven't been largely impacted, will start to see rises in their prices. You may no longer see 99 cents per pound chicken, which I haven't seen. I saw $1.39 the other day. Or you may no longer see $7.88 per pound for steak. Maybe that'll go to $9.99 as a sale now. And ultimately, these goods, as well as even services, are going to rise in cost because workers are going to demand higher wages since their dollar purchasing power doesn't go as far anymore. As well as foreign countries that did not print money, they're going to devalue the Canadian dollar as well as the US dollar because other two countries printed money in this period of time. So we're going to be paying more for these foreign goods or raw materials that are coming in from international trade. And that will ultimately also raise prices locally. So that's my small little warning. For those of you guys who have not yet stepped your feet into investing, at least consider starting now. Start with a small amount. Don't throw all your money in. Maybe you want to follow a similar strategy to what I'm doing right now. Right now, I'm depositing $200 every single week and hoping to grow my $2,000 account, which I started in March, all the way to $50,000 in 3 years. And this is all through just dollar cost averaging investing. It's a very boring method of investing, but it's been a tried and true method over the years to produce returns that are better than the average stock market investor out there. So with that said, let's jump right over into my computer and talk about my portfolio, what I bought, as well as the stock that I sold last week, and what I'm planning to do in this coming week. So jumping into my spreadsheet, my portfolio, you can see the total percentage change. My portfolio is still down by around 0.61%. The total market value is just below $4,600, and the book value is just above $4,600. We can see versus the TSX index, I'm actually down around 6%. So if I invested in an ETF of the TSX index, I would be up 5.4%. Now, I'm not too worried about the short term. Right now, it's only been 3 months or so since I started this portfolio. And now going into the transactions that I made this week, this was the first time that I actually sold a stock. So I sold Stella Jones. And the reason why I sold it is because lumber prices have come down significantly and don't seem to be stopping. Well, if we look at it for the past year, it's quite crazy how lumber prices rose from around. It's pretty crazy that lumber prices 4x in the past year. So right now it seems like we've hit the peak of lumber prices. We can see here in the Wall Street Journal, lumber prices are falling fast, turning hoarders into sellers. So people who have bought wood, especially these companies who buy wood and do some construction on it and sell a more finished product, they're actually selling their wood. We can also see here a picture of Home Depot, how there's a lot of wood on the racks right now. So it seems like supply is high right now and the demand is not there at these current prices. Looking at the first paragraph of this article, futures for July delivery ended Tuesday at just over $1,000 per board feet. They're down 41% from the record of $1,700, which was reached early in May, so literally last month. Futures have declined 14 of the past 16 trading days. So this is bad news for Stella Jones. I think it's more so bad news for the entire sector. Stella Jones themselves probably won't be impacted as much because they're a processor of wood. They're not the ones actually supplying the raw material, so they get raw material, process it, and sell it off to stores like Home Depot. So for that reason, because wood prices have a negative momentum right now, I decided to sell off my Stella Jones to protect my capital and not incur any further losses. My thesis for wood has changed because it's ultimately been proven incorrect. I thought that next year prices for wood would actually continue skyrocketing. However, it seems like lumber is crashing right now. And with an increase of 4 to 5x in this commodity, it's about time that prices are coming down. And then when they come down pretty hard like we've seen already. And I'm thinking we're going to see this going forward in the next couple of months. Now, looking at the stocks that I did buy in this portfolio, I added 2 shares of Sun Life on 2 separate days as it's come back down to my cost basis. I also added some Power Corp of Canada at $39.94, which is still under the net asset value, and added 1 share of TD Bank because this is a small position in my portfolio right now, and I'm trying to build it up because it's a stable dividend paying company. Now going over the total portfolio, if we sort it by market value, highest to lowest, we can see that Power Corp of Canada is my largest position now. It overtook Kinaxis. I'm up 10% on that position, and for Kinaxis, I'm up 5%. I'm still down on Enghouse, and the stock that I'm doing the worst on right now is a Bitcoin ETF. And speaking of Bitcoin, right now, my plan for next week is to add into this position. It's come back down after the recent pop to about $7.50 to $6.50. On the site here, you can see the fear and greed index for crypto. It's at extreme fear at 23 right now on the gauge. Yesterday was extreme fear. Last month was extreme fear. So right now, I believe the market is in a fearful manner, and this is why I'm continuing to pick up shares of the Bitcoin ETF. Be greedy when others are fearful, and be fearful when others are greedy. So I will be adding more this week. And remember, Bitcoin is a short-term play of mine that I'm planning to cash out at the end of this year. Aside from Bitcoin, I did mention last week that I'm going to be buying DCM. So data communications management, I feature this in my previous video on my $43,000 stock market portfolio in Wealthsimple Trade. And I've been buying this stock in that portfolio at 77 cents. But this past week, the stock has just shot up by about 31%. And for that reason, I wasn't able to get in at the price that I wanted to. So I didn't want to rush it. This week, I'm going to be looking for entry point. And looking at the 1-year chart, we can see that this company has excelled from 19 cents all the way to $1.43 for a 652% gain. But as I featured last week talking about the stock that I was planning to buy this week, it's down from its all-time highs of around $1,000 per share in 2004. But the stock, I'm going to be doing a deeper dive this week. Unfortunately, I didn't get around to it last week, so look out for that video this week on DCM, and hopefully I'll catch it if it drops down, possibly forming a cup and handle formation before taking off to the moon. So this week, I'm looking to buy Bitcoin ETF as well as some DCM. And for other stocks I'm going to be buying, I might buy another share of Enghouse because it's down about 10% still. So those are my plans for the buy and sell for this week's portfolio. Again, if you want to stay up to date every single day on this portfolio, you can consider joining my Patreon group where you'll have full access to the sheet. You can make a copy of it and use it for yourself, as well as just monitor it. If you guys enjoyed this video, it was a bit of a longer one, but it would really help me out if you left a thumbs up down below. And remember, I have a Skillshare course down below that will teach you how to build your own spreadsheet from scratch. I'll be throwing up 2 videos on the screen. If you want to check them out, I'll see you there. If not, keep up the grind and have a great day.